Tech stocks have hit record highs, and so has gold. Can the climb continue? And if so, which is a better bet? Coming up, we'll hear from an expert investor, plus get his take on which tech and gold stocks to own. So let's get started. This is Ticker Tape.
John, both tech and gold stocks have been trading at record highs.
Yeah, well, Caroline, people love growth, so that's the tech story. People hate uncertainty, that's part of the gold story. So they might have been going up for different reasons, but at this point, can they continue to go up after going up so much?
Well, we're going to hear from an expert investor who understands both.
Yeah, David Burrows, we've known him for years, Chairman and Chief Investment Officer at Barometer Capital Management.
Let's hear from him now.
David Burrows, thanks for joining us again on Ticker Tape. Good to see you.
Great to be here.
Okay, let's start with tech. Big run. And I think a lot of people are wondering, would it be a surprise to see a bit of a struggle after this big run? What is your view on the outlook from here?
Look, I think that investors expect managers to find their way into the structural themes of things that are being revalued and have a tailwind over a long period of time. And clearly, U.S. stocks kicked off a historic bull market in 2013. It's been a great 12 years. And of course, the star of the show has been technology, partly because it was the only game in town, really, for fast or accelerating economic growth. And that's been going on a long time. But multiples start somewhere, and in a bull market over time, they expand. And the expectations get bigger and bigger and bigger, and it gets harder and harder to beat. So, look, we have to own things like Nvidia and Microsoft. These are companies that are driving the AI revolution, but they're not cheap. And at some point, there will be alternatives that people can invest in that also generate return, which can take away the marginal extra dollar of demand. So we own them. We think they're not inexpensive. And there's very few people that don't own them today. So it wouldn't take a lot to start shifting a little bit of money away from tech. So it's one component of the portfolio. Frankly, at this point, we have an underweight position in technology.
Okay, and we'll talk a little bit more about tech stocks coming up. I want to shift to gold, though. You've had this huge run-up in the price of bullion and gold stocks as well. So similar question. After the run-up we've seen, what do you think happens?
Look, we have to keep an open mind to all kinds of different investment opportunities. I am not a gold bug. And, for the last 3 years, we've spent some time talking about gold, but only because we've been through a major structural change in our economies and in our markets. We've gone from 40 years of falling inflation to a period where, at least up to now, inflation has been pretty sticky and rising, and certain assets just benefit in that world. And gold producers, good ones that actually generate cash, have been able to really grow their cash flow because, of course, the price of gold is moving higher. And not because you and I are speculating on it, because the biggest central banks in the world are picking away and adding gold to their holdings and reducing their exposure to treasury bonds. An inflation asset versus a disinflation asset. And it's completely different than a tech stock.
Okay. So at the end of the day, these are sectors you're continuing to watch. And you would not be surprised if there's a bit of volatility from here. But you talked about cash flows. And when it comes to the stocks that you are invested in, cash flow is one of the key components you're looking at. How come?
Look, in a world where interest rates were falling for 40 years, people who consumed capital had cheaper and cheaper access to money. So the power was in the hands of the borrower. Since 2020, long-term interest rates have moved higher and stayed higher. And I would say the power is in the hands of the lender. So a central theme in the market is no matter which sector has been leading, and there's a number of them, the leading companies have all been companies that have shown an extraordinary ability to grow their cash flow, and in many cases, grow their dividends each year because they don't need to borrow money, they're generating extra cash. So there's companies in the gold sector, there's companies in the tech sector, there's tech companies in other sectors that all have that characteristic, but it's core to what's working in the market.
Coming up, we'll get to David's top picks, but first, a message from today's sponsor, MooMoo. Now, we've been talking about gold. If you're looking to invest on MooMoo, there are tons of gold ETFs and stocks you can explore and discover through their ETF investment themes, making it easy to discover gold ETFs and stocks. As an example, let's take a look at GLD. This is a big, widely known gold ETF backed by gold. Now, since late September, it has had notable performance, versus the QQQ, which tracks the NASDAQ 100. And if you zoom out and look at the last 3 to 5 years, you see returns that have nearly doubled. So right up there with the QQQ. Thanks to MooMoo's ETF comparison feature, it is super easy to line up 2 ETFs side by side, check their historical returns, and instantly see which one fits your strategy. But honestly, what really blew my mind is that MooMoo charges $0 currency exchange fees. Like if you're buying 100 shares of Nvidia at $180 a pop, that's $18,000 US, other brokers might quietly charge $270 in US conversion fees. With MooMoo, it's zero. And if you're a new user, they even refund that trading commission in the first 60 days. So that trade basically costs you nothing. MooMoo's available in 7 countries, has more than 27 million users, and it's fully regulated in Canada. If you haven't tried it yet, check out the link below or scan the QR code. Deposit $100 Canadian, get $50 back. Deposit $5,000, get $300 back. Pretty sweet deal for anyone trading US stocks from Canada. All right, on with the show.
And a friendly reminder, this is not financial advice. Stock group number 1, gold stocks.
Okay, we're going to go through a basket of names, David, that you've had some exposure to. Agnico-Eagle Mines, Alamos, Kinross Gold, Wheaton Precious Metals, and Pan American Silver. Obviously all different companies. Is there a bonding theme there, though?
Yeah, there certainly is. Now, just off the top, let's keep in mind, time frames are short and they're long. We are into a long-term bull market in gold. It's been a great first leg of a bull market. Probably we correct a little in here for 2-3 months. So, for the people that aren't there, and most aren't, there's going to be an opportunity to add. Every one of these companies is different, but they have a common theme. They all are big cash flow generators, and they all benefit as the price of gold moves higher. Their costs are not moving higher nearly as quickly, and the cash flow is growing. In a gold bull market, we also start to get paid for the reserves they have in the ground. And that's a second factor. All of those companies have great assets in the ground. But they're different. Kinross is a growth company. It's Canadian on safe geopolitical grounds with good growth. Agnico is a fabulous operator. They've never disappointed. They've never cut a dividend in 41 years. And that was the go-to name in the last bull market. Alamos is a growth stock, and it's one that's smaller. It's an intermediate. You never know. Some of those intermediate companies get bought by senior companies. So they all have slightly different characteristics, but the common thread is cash flow and safe geopolitical jurisdictions they're working within.
And Wheaton is a streamer, so to speak.
Yeah, the difference there is when you are a streamer like Wheaton Precious Metals, they've made investments in many, many, many different gold projects and silver projects. They get paid a royalty on the revenue that's generated in each of those projects. It doesn't matter how those companies manage their costs, they still have to pay Wheaton. And if they disappear and go bankrupt, Wheaton's royalty is attached to the property. Whoever might operate that in the future still has to pay Wheaton. So it's a little safer, a little bit less octane, but it's a great position for a long-term hold in a long-term bull market.
Stock group number 2, tech stocks.
Okay, so now we're getting into some names that have come up a lot on Ticker Take, David. The likes of Microsoft, Alphabet, Nvidia, which you already referenced, Broadcom. These are names that you've had positions in. I'm going to add in Take-Two as well, video game player, but a tech company, software company as well. Same question as the golds. Is there a common theme? I know they're all very different, but is that cash flow theme true here too?
Look, none of these companies are pie in the sky. Someday in the future, there's going to be value. These are great, mature operating businesses. And if you forget about what they produce, they are generating an ever-growing stream of cash. And in many cases, providing investors with an ever-growing stream of dividends. So look, multiples can expand to a certain point. You need to continue to see growth. The one thing we've heard and we know is that capital spending isn't going away. So companies like Nvidia are going to continue to do very well. Microsoft is the only one of these companies that's generating $20 billion in cash flow and not selling hardware. This is from services, which is really of value. When you look at Google, the opportunity that they have to apply AI through their business. They were seen as a laggard at the beginning.
They were.
But of course, Gemini at this point now is really coming to the front, and the opportunities that they have with AI at YouTube is extraordinary. And it appears like there really isn't as much risk as we thought in the Google browser, being taken out of Apple. So they all have different characteristics, but they're all have been very, very good at being predictable. They all have been done a good job at exceeding expectations. And you can't deny the fact that they have the ability to set price. And when you can set price, if there's inflation, set price, raise price tomorrow, that means you can offset and be a hedge against inflation. And all of these companies are things that we need to own to protect against the debasement of our purchasing power with cash.
So you talked earlier in gold's case with the fact that we're in a bull market. You would not be surprised to see a leg lower during this bull market, which maybe for people who didn't invest in gold stocks might be an opportunity. Same question with tech, because I think a lot of people ask, at these levels, how would you feel about investing?
Well, the question is, where's the next marginal dollar of demand coming from? Keep in mind, in Japan for 30 years, their stock market didn't make any progress and their yen was moving lower. So slowly over time, investment committees bought a little more US dollars, buy a few more US stocks. And after 30 years, they're probably as long as they can be. And the same for the Europeans over the last 15 years and the South Americans over the last 10 years. Their markets went nowhere and their currency was weak. In the last 18 months, now all their currencies are getting better. And in fact, international stocks, ex-US, are outperforming US markets. And they may or may not like the guy south of the border. So is it possible that some of them might say, we're going to take some of that capital home because we now have a diversifying opportunity?
And take it out of tech.
And take it out. And everybody owns tech. They probably don't need to use more, have more. It could be a source of cash. So that could cause correction going forward.
And stock group number 3, other top stock picks.
All right, 3 more names we just wanted to share with people outside of tech and outside of gold, but they're companies that you watch very closely. In banking, JPMorgan, well-known name. In Spain, Santander, Banco Santander. In energy, Imperial Oil. So you talked about how money is going to other areas beyond tech, and you also talked about your love of cash flow.
Right.
Is that what brings these names into the mix?
Look, we go back to the structural change in the market. If we've moved into a world where inflation is likely to stay more sticky, we want companies that generate cash. We want companies that raise their dividend. There are certain industries that benefit in a more inflationary world. If the power is in the hands of the lender, well, JPMorgan is the biggest lender in the world. And they are a dynamite company with great management, great systems, probably best tech for banking of any company. But it's not inexpensive. And so Santander is an extension of that. It's the largest bank outside of the US. It's a $170 billion value, but it trades at 9 times earnings, not 17 times earnings. And it has exposure to consumer markets growing in South America and Europe with a great digital platform. Both are dividend payers and both have excellent dividend growth. If you extend that further into energy, which we don't often think of as big dividend payers, but Imperial Oil is a serial dividend payer, generating an enormous amount of cash. They've paid down debt over the years. And what I think we underappreciate is if you've got 40 years worth of reserves sitting in the ground, it's very different than a shale oil producer in the US that if they stop fracking the ground, they stop getting oil out. So as a long-term cash flow generator, all 3 of those fit the bill: financials, energy, precious metals, tech. They all are generating these things, but they're all different.
Great perspective, as always. David Burrows, thanks for your time.
Thanks for having me.
All right, our thanks to David Burrows. If you want to learn more about David, we've put some info in the description below.
Where there's all sorts of other ways you can connect with us, whether through our free investing newsletter or the podcast edition of Ticker Take. And of course, make sure you subscribed on YouTube so you never miss our investing videos. See you next time.